Welcome, friends, in the series of simplifying financial jargons. Let us understand some new terms today, like budget deficit, fiscal deficit, revenue expenses, revenue income, and revenue deficit, balance of trade, all these terms. So, first of all, let us understand deficit. Then we will understand different types of deficit. Deficit, in simple term, is deficiency in quantity or quality of anything. If there is some deficiency, some shortfall in quantity or quality, then it is a deficit. If there is no shortfall, opposite of that, then it will be a surplus. Suppose you purchased 100 mango, but the trader or shopkeeper gave you 90 only. So the 10 will be deficit quantity supplied. So this is the simple term of deficit. Now let us understand budget deficit. Budget deficit occurs when an entity, often government, normally government only refer, spends more money than it takes. It is a notional. Government makes a budget, and in budget, whatever expected or budgeted intakes are or revenue from revenue sources or from capital receipts from any receipt, total receipts, and whatever government want to expand. So if there is shortfall, or we can say in simple term, if government wanted to expand more than it takes, then it is a budget deficit. Now understand fiscal deficit. It is a actual deficit. When the government incurs more expenses than the income it makes, then it is a budget fiscal deficit. The difference or deficit between the two termed as fiscal deficit. So what is fiscal deficit, or in formula if you want to fit it, then it will be fiscal deficit is equal to government total expense minus government total receipts. Of course, excluding borrowings. Borrowings we cannot take. Government total receipts means from revenue sources or from capital receipts. That will be only taken account. Balance we cannot. So this will be a fiscal deficit for a government or for any country. Now arises another thing, another question. Okay, what is expense or revenue expenses? The revenue expense is any government incurred in running its day-to-day business, like paying salary to its staff or electricity bill, anything expenditure happened, or even a interest payment, all this will come under revenue expenditure. So revenue expenditure is the expense incurred for the normal running of the government, various department and services, interest paid or subsidies. All this expenditure will come under revenue expenditure. Now, another type of expenditure is capital expenditure or a capital expense. So, expense incurs, or we can say capital expenditure includes all expenses incurred by government by creating assets like money spent on constructing a hospital or any company creation like ONGC, GAIL, Coal India. So government have created so many companies. If government creates some assets by expenditure, then it will be a capital expense. Wherever this revenue expenditure is not creating any assets, this is the simple difference. Now coming another term, r- revenue, because we are just discussing revenue expenditure, capital expenditure. So first understand now revenue. So government, any government gets revenue from two sources, main two part. First is tax sources and second is non-tax sources. From tax sources are also two different. One is direct tax, another is indirect tax, like personal income, corporate incomes, GST. So any type of tax, VAT are there. So all this comes under some type of taxes. And these are the sources of government revenue. There are some other non-tax sources also, like capital receipts or revenue receipts. Government providing so many services, rendering so many services, and they are getting some revenue. So these will come under non tax revenues. Normally, these capital revenues or capital receipts are one time income, but tax re- revenues are incurring, or we can say getting every year. So each year we are getting. So every government try to increase revenue from tax sources, which is getting the every year by year. Now, another question is coming. Is there any revenue deficit or no? If government getting less revenue than its expenses, definitely there is revenue deficit. The difference between revenue expenditure and revenue receipt is revenue deficit. Just now we have discussed revenue receipts, sources of our revenue receipts, all direct tax, indirect tax, non tax sources consisting of all interest, dividends on investments, fees, or other receipts of services provided by government entities. If all these receipts are less than government expenditure, then there will be revenue deficit. Now, another term is balance of trade. Any country definitely do some import and some exports. If countries export minus import is positive, then it is trade surplus. If it is negative, then it is trade deficit. And from here it comes term balance of trade. So any country want to have positive balance of trade. That means any country want to export more than they import. And if balance of trade is positive, that indicates country's economic health in good condition. So all countries strive for having positive balance of trade. These are the some terms we discussed. We will see some new terms tomorrow. Till then, we have to close today. If you find some value in today's discussion, please like this channel and subscribe to it also if not subscribed so far. And please do share with your friends and colleagues so that they can also get some benefit out of this. Till then, thank you. Bye bye. See you again tomorrow.